Investors who build wealth and investors who miss wealth are often investing in the exact same market. Do you know what makes the difference? Most people believe that wealth is built when markets are rising, but often the decisions made during quiet and uneventful markets have the biggest impact on the long term wealth. Parents face a similar challenge. Everyone wants the best future for the child. But how much is the education cost? How much you should invest? And are you doing enough today? These are questions many families still struggle to answer. That's why we are hosting two special sessions on 20th June this Saturday. Why most investors miss wealth during boring markets at 11 a.m. a live webinar with Durai. At 4 p.m. we have Investing for Your Child, What Most Parents Get Wrong, featuring Ashna Bagdi, and we are excited to launch it as our first YouTube premiere. So register now using the link below. One session is about building wealth and the other is building your child's future. Join us.
What has the war taught us? Every time we have a war, the immediate priority for India is to see how our macros are impacted. The Iran war has probably shaken our domestic macros like no other war. The Russia Ukraine war didn't impact us so much. In recent years, none of the wars have impacted the Indian macros like the Iran war because the war touched a very, very raw spot in our economy. It disrupted the logistics, which was critical for our energy security. It also disrupted the cost of our energy security. When both the cost and logistics got disrupted, our macros turned very fast and weakened very abruptly. At the beginning of the calendar year, on January 1, or on the day of the budget on February 1, nobody foresaw this kind of a weakening in our macros. Between the 1st of March and the 1st of June, what we saw was quite unprecedented. To make it worse, we also saw very significant FII outflows. While these FII outflows were happening and were very significant, the FDI also turned net negative. Effectively, FDI used to cushion many things. Having a net positive foreign direct investment of a significant order always helped our economy cushion against FII outflows and even trade deficit. It was the counterweight or the stabilizer to the rupee. When we lost that counterweight or stabilizing force, the rupee started weakening far more than it would over a year. So we saw a double digit weakening of the rupee against the dollar and against some other currencies as well. Effectively, the economic macros became weak in ways which we had probably not anticipated months earlier. It was too sudden, it was too abrupt, and it was very, very strong. If you took stock on June 1, you would have felt that if this war doesn't end, India is going to be in a big spot of bother. Adding to that, the Indian economy and the stock market stopped looking attractive enough to global investors because what they were chasing was something else. But in this month alone, there have been significant changes to the scenario. The setting has dramatically altered so far in just 2 weeks. First, We are seeing light at the end of the tunnel as far as the war is concerned. The war may well end. All indicators like oil prices, freight rates, what's happening to gold, what's happening to other asset classes indicate that probably this war may end. If the war ends, you still need to give some time for the supply chain to be set right for crude and other energy products like LPG and so many other products, petrol, diesel, LPG, your gas, LNG, everything. Once that supply chain falls in place, then global prices of all these commodities will settle down. In the interim, India has to do a lot of damage control because the damage in just a few months, March, April, May, to the global sentiment on India has to be set right. We need to do a lot of things right. This is where the government making investment in government securities and bonds tax free for global investors and also agreeing to pay the hedging cost to Indian banks for FCNR receipts are all small steps in the right direction. More moves are in the offing. As we do this video, I read that SEBI is going to allow companies to buy back shares on the stock exchanges. This is a very welcome move. All this will stabilize sentiment, support sentiment, and set up the market for betterment of sentiment. So things are slowly falling in place. Now let us see how we approached this scenario of things gradually falling in place just a few weeks ago. I saw a lot of people losing their patience. I saw a lot of people come and tell me, this market is useless. I have not made any return for 2 years. I could have done speculation in real estate instead of this. I could have gone and put the money in fixed deposit. The usual stuff. When I saw that, I was thinking that probably this behavior is telling me that a bottom in the near term could be around. Now, with the war likely to end, with things settling down, with the logistics coming back to normalcy, with exchange rate probably seeing some relief from lower oil prices and maybe more relief from flows of capital into India, we are slowly moving towards a better place. But the damage to our macros done in 3 months may not be undone as fast as we would like it to be. It may take more time than that, that's for sure. It will take longer than 3 months. It may take longer than even what we are comfortable with or what we are expecting it to take. That's where an investor's temperament and behavior are going to matter now. This is a time when you're suddenly seeing commodity prices, which kept going up, suddenly start going down. You're seeing the trend in aluminium, you're going to see the trend in crude, you'll see it spread across commodities. Commodities softening is something that nobody would have expected on the 1st of June. So essentially, our macros are turning so fast that we have to only respond. It's very difficult to prepare. And we have to respond clinically. And we need to respond swiftly. You can't just sit and say, okay, let me see, let me think for another few months, then decide. Because the opportunities that these very sharp swings throw at you need to be taken advantage of. So you need to invest when the market becomes very scared. You need to invest when the market is irrational. You need to invest where the fears are overstated in the market. And you need to invest when that fear is actually around its peak. It means that you have to bring out the best of contrarian behavior in your investing. That's something I see a very small section of people do it, and I see a very large section of people not doing what is right for their own portfolios. That's been my observation of the recent months. I saw patients running down too much, running down more than it should, running down at a pace which I felt was very high. So, how this patience is going to get rebuilt, how people are going to recover as more patient investors, and how they are going to play this market as it tests your patience on the road to recovery are all very, very critical success factors for your investing. An extraordinary year is what I would call 2026. It's going to see volatility of an order which we probably were unprepared for at the beginning of the year. We already seen a lot of volatility, but trust me, there'll be more in store. As an investor, you cannot predict them. You cannot predict volatility, but you can always prepare to respond when volatility presents opportunity before you. And that's the most important thing which an investor should do right now. Thank you for watching this video.